So now let's move on to the next topic, which is market cycles. You have heard the terms market boom and bust cycles. You have also heard of market bubbles or a market sell-off. These are basically phases of the market. In fact, all markets go through the same phases and they tend to be cyclical in the long term. It is very important for market participants to be able to recognize the prevalent market cycle in order to make the correct investing or trading decision. Markets move in four phases, and understanding how each phase works and how you can benefit from it is very important. The first is the accumulation phase. This phase occurs after the market has bottomed out. The overall market sentiment is still bearish, but valuations become attractive. This attracts the smart money and they start buying. Most people here would have sold their holdings, and as most sellers are out, prices begin to flatten out. This is the time sentiment shifts from bearish to neutral. The next phase, that is the markup phase, the market becomes stable and slowly begins to move higher. In this phase, the experienced traders and the technical analysts begin to see that the market direction is changing. They are early adopters and begin to buy. As the phase matures, more investors jump in as FOMO kicks in. Overall sentiment changes from neutral to bullish. As the phase comes to an end, the last of the lot are buying, as everyone wants to participate now in the markets. As the late majority is entering, the smart money and the early adopters are unloading their positions. This is where bullishness becomes greed. Slowly prices level off as overall demand slows down. People who did not buy yet see this as an entry opportunity. So let's see over here. So this is the markup phase, and then over here you can see parabolic moves. This is the last phase where late entrants kind of enter and smart money tends to book out. And then this leads to the start of the distribution phase as demand goes down and early adopters and people who made positions here are selling out here. So the next is the distribution phase. This is when sentiment changes from bullish to mixed or neutral. Prices start moving in a range for long periods as buying slows and selling increases. Valuations here are very high, while hope and greed are still prevalent in the market. Since no more smart money is coming in at these extreme levels, sentiment begins to change and people look to book profits or get out at a small loss. But people here, I mean anyone who's entered late also, or anyone who is entered along with this parabolic move, they also try to exit here. The final stage is the markdown phase. As markets start to fall, people who entered late are now sitting on losses, but are holding their positions. People refuse to let go and keep holding till they see further pain in the markets. So this is the phase where you can see a lot of the markdown has started, but a lot of people are still expecting the prices to rise and are holding on to their loss-making positions. As the pace of the fall increases, a lot of these people are forced to sell, leading to further fall in prices. As prices hit extreme lows, the smart money starts looking at opportunities again. So over here, and then eventually over here. And as smart money starts looking at opportunities again, they again to build their positions, the cycle continues to play out again. So here we have the accumulation, and post that the markup phase starts again. So all markets go through the same phases and are cyclical. They rise, they peak, they dip, and then they bottom out. By all markets, I mean this includes the stock market, the commodity markets, even the market for wood or the market for real estate. So this works in all markets. When one market cycle is finished, the next one begins. So markup stage only comes after the accumulation stage. The distribution stage leads to markdown stage, or it could also lead to another markup stage. We'll talk about this later, but one stage tends to lead to the other. The problem is that most investors and traders either fail to recognize that markets are cyclical or forget to expect the end of the current market phase. So now that you are aware, you should expect that each phase eventually will come to an end. An understanding of cycles is essential if you want to maximize your investing and trading returns. So there are a lot of factors that influence the market cycle, especially in the stock markets. Some of them are the economic cycle, the GDP growth of a country, and any global events such as war or a pandemic and stuff like that. Now let's discuss economic cycles. An economic cycle is the overall state of the economy as it goes through the four stages in a cyclical pattern. The four stages of the cycle are expansion, peak, contraction, and trough. Factors such as GDP, interest rate, total employment, and consumer spending can help determine the current stage of the economic cycle. So you can think of the economic cycle like seasons of the year. There are no regular intervals but recognizable indicators to help us distinguish between different seasons. So let's talk about the first stage, which is the expansion phase. In this phase, the economy experiences rapid growth. As GDP grows, both production and consumption increases, unemployment is low, and overall markets are bullish. Eventually, a lot of balances are built up and growth is maxed out. Things eventually peak and they start correcting. Contraction, the next phase. As the correction occurs, GDP falls, unemployment goes up, and growth slows down. Also, the stocks tend to fall and enter a bear market. If the contraction goes unchecked, it can lead to recession. So, the next is the trough. The trough marks the end of the recession or the economic slowdown. Low prices cause increase in demand and this kicks off production. Unemployment reduces and we slowly start growing again. So monetary and fiscal policies are used by the government and the central banks to regulate a country's economic activity over time. So the government implements the fiscal policy by using tax schemes or incentives and government spending to boost long-term economic growth, while monetary policy, which entails managing interest rates to control inflation and money flow by central bank, ensures smooth functioning of the money flow in the economy. So this expansion and contraction of an economy are very normal and they keep playing out and they keep imbalances in check. So the economic cycle influences the stock markets differently. So it influences various sectors of the stock markets differently. And investors generally tend to rotate money between sectors as the economic cycles play out. For example, in an expansion stage, financials tend to do very well. Businesses invest in technology to expand, so technology sector does well. Discretionary sector does well. Retail does well. People are buying cars. People are buying houses. However, in a recession, sectors that are less sensitive to the economic cycle tend to do well, such as utilities, essentials like food, FMCG, healthcare, consumer staples. So one needs to be aware of the prevalent economic cycle in order to make better investment decisions. So over here you can study the economic cycle and the market cycle as they play out together. So continuing our discussion on cycles, let's look at how cycles play out in individual sectors and stocks. Let's start the discussion here with the real estate sector. So over here we have a graph of the occupancy rate against time, and we can clearly see the four phases of the real estate cycle, which are recovery, expansion, hypersupply, and recession. So in the first phase, that is a recovery phase, we are usually coming out of an economic recession and the demand for rentals and housing is low. There is no new construction happening. However, this is a good time as an investor to look for deals that are below market value. So as the economy recovers, the real estate cycle also moves into the next phase, that is the expansion phase. Job growth is strong and there is increased demand for space and housing. People gain confidence and renters and home buyers start generating new demand. In this phase, property developers kickstart new construction to meet the rising demand. Many new projects are launched and the market value for properties and rents increases. As investors and developers get into a frenzy to ensure supply meets demand, eventually there comes a tipping point at which supply exceeds demand. So this is the equilibrium, and now we're talking about what happens post this. A lot of projects that were started in the expansion phase are now getting complete, as it takes considerable time for a real estate development to complete. So now the supply far exceeds demand. So we are in the hyper supply phase now. And there is a lot of inventory buildup. And maybe economic conditions have changed with time or something. But the vacancy rate starts increasing. And property owners are unable to find renters or buyers very easily. So new construction is still happening because projects that were started here are still getting finished. So basically the supply has far outnumbered the demand. So in case the economic conditions don't improve and we go into a recession or economic slowdown, so a lot of property owners suffer from the rising vacancy rates. They are forced to reduce their rentals and to attract people who are willing to pay only basically reduce the rent. Some of the owners may not be able to pay their housing loans and rents have fallen and they need to liquidate assets. Thus, this creates an opportunity for investors to purchase distressed properties at deep discounts. So value investors tend to reappear during this stage and buy these assets, and they tend to hold on to them till the economic cycle plays out again and the recovery begins.